Dividend Gold investors, bonjour, Michael here. Welcome to this Canadian Banks quarterly earnings review video. Every quarter, I review the big six and I do some comments on EQ Bank and Go Easy. I like to review banks mostly because it tells us a lot about the economy and what is likely going to happen for the rest of the year on the stock market as well. So let's get started with the performance over the past 12 months right here. As you can see, small banks are in the winning pool. So EQ Bank, Go Easy up 45%, up 39%. And then National Bank, which is the smallest of the big six, up 11% in the past 12 months. Kind of interesting because we're going to talk about it later on in this video. But EQ Bank yesterday reported a pretty solid quarter, but share price tumbled. So even if it's tumbled yesterday, when you look at the past 12 months, it doesn't even show on the graph. So sometimes, you can get some panic because the stock price goes down. But if you put that into a short-term and then mid-term graph, you don't see it anymore. And imagine if you would have put the return on EQ Bank for the past 5 or 10 years, that small drop yesterday would not even show at all. So the first quarter of the year for banks is pretty flat, not super exciting, mostly because we don't talk about dividend increases. They all happened and they were mostly announced last quarter. Only Scotiabank actually did not announce a dividend increase at that time, but they increased it before that in 23. So what you see here is no dividend increase for anything, but then you see a wide variation for the adjusted earnings per share for the quarter. So it goes for the most positive with National Bank at +2, which is the only bank that recorded positive earnings growth. And all the way down to BMO, which is down 16%, and altogether it was a pretty terrible quarter for them. A lot of bad news, a lot of charges. Of course, all banks will mention two key things in their earnings: higher PCL, so higher provision for credit losses, telling us their loan portfolio is not incredibly healthy. It is actually a little bit at risk. And the second thing is they suffer from inflation too. So they show higher expenses and many business segments, which affected earnings. And when it comes to yield, it's pretty much the same thing. You have a wide diversification here, going from National Bank and Royal Bank in the low 4%, all the way up to Scotiabank offering you 6.5. So when you're telling me, but Mike, I'm buying Canadian banks, they're all the same, it's all the same thing. It's not. As you can see, there are big differences now with the best performing banks and the worst performing banks. The yield is different. The business model is starting to be a little bit more different quarter after quarter. And at this stage, you are not buying the same. So you might want to do a little bit more due diligence and look a little bit more deeper in the financial metrics to understand which bank is the best for your portfolio. In terms of payout ratio, we also see a similar trend. So we have a few that are around 60%. So CIBC, BMO, Scotiabank. Of course, for BMO, it was a really bad quarter. Usually they're a little bit more around 50%. Now they're getting closer to 60. Again, nothing to worry about now. But when you're seeing those payout ratios getting higher and higher like this, it tells you one thing. It tells you that it will eventually slow down the dividend growth policy that they have, because they will not be able to keep up with a healthy balance sheet. And God knows regulation requires them to have a very solid balance sheet. Well, then they will not be able to grow their dividend that fast if they continue to show a higher payout ratio, especially because you have on the other side some banks offering you like a 40 and 50% payout ratio. So I reviewed all Canadian banks quarter, and one thing that came out pretty obvious for all banks was really the fact that the revenues are increasing due to higher interest rates, which has been a narrative for the past 5 quarters, and also higher expenses. So it's not just PCLs anymore, but now they pay more commission, they pay more bonuses, wages are increasing. And one thing that happened also in the US for banks like CIBC and TD, for example, they had to pay a FDIC special assessment that came after the bank crisis. So the FDIC is the insurance for customers when they have GICs or banks accounts over there. They want to make sure that their money is insured to avoid bank run. So they need a special assessment because we had a few banks that went, like Silicon Valley Bank, for example, at the beginning of 23, that ran into some problems with their deposits, and then there was a bank run, and it created a big crater in their book. So the FDIC didn't want that to happen again. So they asked all banks to review everything. So that special assessment actually hurt a lot the results. For BMO, on top of higher expenses, on top of higher provision for credit losses, their capital market segment did not go well. I keep telling you this, capital markets is amazing because in many cases it will save the day. It is highly profitable, but also highly volatile. As you can see just on that graph, you see that it goes from minus 17% to plus 3% at National Bank. So definitely what they do within that business segment could be very different from one place to another. In terms of personal and commercial loan in Canada, overall, it was a pretty good quarter for most of them. BMO was down 3%, but if you look at National Bank, TD, and Scotiabank, they were all up low single digit. Royal Bank down 3%, not the end of the world. So especially because they had like deposits and loans that were growing very fast. Unfortunately, again, PCLs was there to ruin the party. And I have to put a special mention for CIBC that reported an increase of 10% for the personal and commercial business in Canada. In the US, as you can see, if you do business in the US, you have not made much money. If you are BMO, TD, and CIBC, for Scotiabank, it's actually not US, but international. So they're up 16%. That was a pretty good quarter on the international side. Provision for credit losses did not affect them too much. And for National Bank, they have a bit of US, a bit of Cambodia with Alba Bank, but the bulk of the results, the positive results, came from Alba Bank. So overall, it was a pretty solid quarter for National Bank, better than expected at CIBC and Scotiabank, and a okay quarter for Royal and TD. And definitely a bad quarter for BMO. And we have another bad news about BMO, but not right now. We're going to move towards the valuation. And at the end of the video, we're going to talk a little bit more about another problem that 3 of those banks have currently in their balance sheet. Moving up to the forward P ratio, as you can see, not much has changed as of late. We see that between October and January, everybody went up a little bit. That was because we started to have some hints that interest rates will not increase anymore. And now we have some chances to see them decrease, which will definitely be good for provision for credit losses for all banks. The valuation goes from the cheapest right now with CIBC at 9.6 all the way up to the most expensive at Royal Bank and National Bank, slightly above 11 times their earnings. But when you look at that PE ratio, I would not say that the best value is at CIBC. When you look at all of them, you see that CIBC, Scotiabank has like weaker growth vectors. They have like a little bit more difficulties. And then National Bank and Royal Bank are more diversified. They have like 50% of their business model that is not attached to the classic banking industry, so credit and loans. So for those reasons, you're paying a little bit more for quality and performance, while for Scotiabank and CIBC, it's a little bit harder, and this is why you don't have to pay the same price. So again, when I'm telling you that there's a difference between each bank, well, if you want to go for diversification, you want to go for National Bank and Royal Bank. If you want to have a stronger US exposure, you go for TD. If you want more to invest into the wealth management and the capital markets, you go with BMO. If you're not too sure where to go, CIBC is pretty much aligned with you because they are touching a little bit of everything, but they do not have a clear strategy as the other banks. And then for Scotia, it's the international diversification that you're getting up. But that narrative has not been proven to be successful in the past 10 years. So I am still quite skeptical it's going to continue to perform in the future. Most of the time, banking in Central America and South America brings more volatility than anything else. But over the long run, there's absolutely no proof that it is a great thing to be exposed to those markets as opposed to do business in Canada and in the US. Speaking of strategy and niche market, EQ Bank and GoEasy also reported their earnings, and man, those small banks are beasts. It's important to understand though that they are completely different. I mean, EQ Bank is like $2 or $3 billion market share, where National Bank's at 35, and then Royal Bank is like 180, 190 billion. So there is definitely a big difference in terms of size. So for EQ Bank, they are in beast mode. Revenue were up 27%, earnings per share was up 24%, and they increased their dividend by another 5%. They use aggressive marketing. They're trying to grab market shares, and it is working. Their provision for credit losses remains really low, but so far, so good. It's making a lot of sense. So why in the world EQ Bank drop on earnings day? Well, the thing is, the more you report great numbers, the more the market price your stock according to even better numbers the next time. So it's all about expectations. So even if the bank reported double-digit growth, it was just not enough for what the market has priced. They expected more, so therefore it was not good enough. Think about Connor McDavid. If he has like a season of like 100 points, it's not that great. I mean, it's okay. It's good. I mean, it's amazing season for a lot of people, but for Connor McDavid, 100 points for a year, it's just not making it, right? It's below the expectation. So depending on if you're looking at Connor McDavid or if you're looking at a regular player like Nick Suzuki, if Nick Suzuki does 100 points, we're all going to be jumping around, right? And it's going to be like, oh my God, he finally broke it. He's becoming one of the best centers in the NHL. But now, McDavid, 100 point, not much. So exactly, EQ Bank is in that situation right now. And I'm not saying that EQ Bank is going to be like the best performing banks for a very long time, but so far, they're young, they're small, and they are delivering. And it has been good for like what, 5-10 years now. So definitely EQ Bank could add a little bit more push to your portfolio, but be wary of that volatility. Now, a quick note on GoEasy, which is on a very solid recovery part. They dropped big time in 2022, but now they are going up. Revenues going up 24%, earnings per share going up 32%, and the dividend was increased by 22%. So double digit across the board once again. And GoEasy is just like walking towards a lot of headwinds coming from the market. The market is just thinking GoEasy at one point in time, they will fail. The thing is, their credit performance is amazing, but they are playing with fire. They are allowing loans at higher interest rates to people that could probably not get them into regular banks. So their underwriting process is key. So far, it has been amazing. Just to give you an idea, their target for the write-off, so like loans that they will give away but they will lose, it's between 8.5 to 9.5% of their loans. And the write-off for the latest quarter was at 8.8, so right on the target. So as long as they price their loans and they price their business model with this kind of targets, with almost 10% of their loans that are going to go belly up, well, whenever they stay in that target, they are highly profitable, and this is working very well for GoEasy. So again, not too sure how they will perform in a recession, but so far they have proven us that they are able to maintain the cap and keep on growing at a very solid pace. Now I'm going to end this video about another problem that the big guys are facing, actually more specifically BMO, TD, and CIBC, because they allowed mortgage with variable rate that do not increase according to interest rates. So that means that for the past 3 years, we have now clients that are paying a smaller mortgage payment while the real rate has increased and big time. So this means that now they have a negative amortization. So the amortization every month, their loan is actually getting bigger and bigger. So when it's going to come time to renew, those clients will face some problems. mostly because they will have either two choices: either pay like a very steep amount per month to bring that mortgage back, or renegotiate the entire amortization to package it in a different way. On average, about 25% of BMO's, TD, and CIBC mortgages are in that situation right now. But I don't think it's going to be a major problem for them. First, they're well capitalized, and second, most clients will not just give their keys back. They will try to find a solution. They don't want to go bankrupt. They don't want to lose their house. So they will sit down with the bank. And actually, the bank doesn't want to take that house either. So probably that in the end, for most loans, it's going to end up with client paying a lot more interest for a lot longer time, which equals to a lot more profit for those banks. So maybe this is a strange situation where it seems to be a dark cloud, but maybe behind the dark cloud, there will be a nice and sunny day. So we'll have to see. Of course, it is something that needs to be monitored every quarter to see the situation. There's definitely a link to see how their provision for credit losses increases versus those mortgage rate, but they do provide that in their investors presentation. If you dig deep enough, you will find those charts. So that is interesting to monitor if you hold them in your portfolio. Fortunately, I have National Bank and Royal Bank in mind, a very small position in my Smith maneuver for TD, so I'm not that worried about it, and I'm not going to necessarily actively monitor that part because it's not significant in my portfolio. But if you have a significant investment in BMO, TD, or CIBC, you really want to look at that. All right, guys, I hope that you have enjoyed this video. Don't forget to give me a thumbs up and subscribe to the channel to not miss my next video on next Thursday. And until then, don't forget to stay invested.